The Fed cut rates by 0.5%, but what does that mean for you? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005. And here is the market data that you need to make an informed buying or selling decision or help your client do the same. This month will be short and sweet, and I'll cover what I've been asked about most, which is the Fed finally beginning their interest rate cutting cycle. So the Fed cut rates by 0.5% on September 18th, which might leave you asking, does that mean my mortgage rate is 0.5% lower? The answer is no. The Fed does not set mortgage rates. Mortgages are long-term interest rate products which are mostly sensitive to inflation. When the Fed adjusts interest rates, they are directly impacting short-term interest rate products such as credit cards and equity lines of credit, but they are not directly impacting mortgage rates. The Fed's actions do, however, indirectly impact mortgage rates because their actions impact inflation, which in turn impacts long-term interest rate products such as 30-year mortgages. In this particular case, the market was already anticipating a rate cut because inflation readings were coming in pretty tame over the last couple of months, and the labor market began to show signs of weakening, which created concerns of an economic slowdown. All of these factors point to lower long-term interest rates, and therefore the market priced in this drop in rates before the Fed actually even made the announcement. So that's what's happened. But what does that mean to you as a realtor or you as a home buyer or seller? What you need to know is that the rate cutting cycle has begun and there will be more cuts this year and next year. Now, if you're a buyer, you might think, great, I'll wait for rates to drop some more and then I'll buy my new home. But there is something you might want to consider. What do you think everybody else is doing? I've said this many times before. If you wait for a better mortgage rate, you're going to end up paying much more for a house that you could have had today at a lower price. And that increase in cost will not be offset by a lower mortgage rate. If you wait, you will be competing with other buyers who also chose to wait, and waiting will be what the majority of people choose to do. Moreover, when mortgage rates drop, affordability increases. Therefore, home prices will be bid up, not just because of an increase in buyers, but also because of increased affordability. If you're a realtor, you really need to educate your clients on this concept because it's to their benefit. Now, for some of you watching this, you might think, well, most of my clients pay cash anyway. Why should I care? Well, you should, because cash clients still have an opportunity cost to consider when they move their money. If a client buys a house in cash, they are pulling their money from somewhere, and it's not their checking account. If they're taking a margin line of credit against their brokerage account, for example, that has an interest cost. If they are taking their money out of treasuries, that means they are moving money from an interest-bearing instrument, treasuries, into a non-interest-bearing instrument, their new home. And this has an opportunity cost. Currently, the 1-month treasury yields an annualized return of 5%. In 2021, when we were at peak buy demand coming out of the pandemic, the 1-month treasury rate was barely above 0%. That's a 5% difference from just 3 short years ago. It's night and day. Money would obviously be more willing to move when a return on investment is close to 0% as opposed to 5%. So here's the point. If your client's mostly paying cash, when you hear that rates drop, going forward, I want you to think that your client's money is now more willing to move. When rates are high, there are a lot of safe investments, such as treasuries, that yield a good return and that makes money less willing to move. When rates are low, money moves with less friction because the opportunity cost is less. So if you only deal with cash clients, you better bet that interest rates should interest you. In closing, last but not least, if you are already a homeowner and are wondering if you should inquire about refinancing, if your loan was originated prior to mid-2022, there's probably not a whole lot to talk about as your current rate is most likely lower than whatever is available now. If your current mortgage was originated after mid-2022, then it's worth at least having a conversation to see where things are for you at present and when would be the ideal timing of a refinance for you. That's a wrap for the October market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, Feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.